and welcome. Thank you for tuning in to our UI Brasil podcast series. I'm Gustavo Carmona, a partner based here in São Paulo, and I lead our Brazil International Tax and Transaction Services practice. I'm here today with Priscila, also my partner based in São Paulo, and with José Murillo, a partner of UI based in Washington, D.C., and the leader of our International Tax and Transaction Services practice for the Americas. We are here today to talk a little bit about the OECD Pillar 2 initiative and the recent developments, especially the side-by-side package. But I think to start, I would ask Priscila maybe to give us a little bit of context of even what is Pillar 2 for those that are not so familiar yet, and where we stand in relation to Pillar 2. What is the side-by-side package, Priscila?
Okay. Well, the Pillar 2 actually is part, as you mentioned, is an OECD initiative, so it's part of the BEPS project, Base Erosion Profit Shift of OECD. The idea of the Pillar 2 was to avoid a tax war among jurisdictions to try to reduce the corporate income tax rate. So what Pillar 2 tries to achieve is that all big multinational groups, they will be paying at least 15% of corporate income tax in each jurisdictions where they operate. In order to make this happen, the system of the Pillar 2 was developed with three mechanisms for the top-up tax. So three mechanisms to collect this additional tax to reach the 15% taxation. One of them is the QDMTT, which is the top-up tax applicable and collected at the jurisdiction that is with the lower ETR. The IIR, income inclusion rules, and here the top-up tax is collected by the UPE, so the headquarters of the multinational group, and the UTPR, which is a third mechanism that any jurisdiction that's part of the multinational group that has passed this legislation is allowed to collect the top-up tax. So it can be collected in respect of the shareholder, subsidiaries, sister companies. This was the mechanic to say that there was no escape out of Pillar 2 because once the jurisdiction started to implement one or the other mechanism, at the end of the day, you would be collecting anyhow the top-up tax. So this was an incentive. The way this was designed was an incentive for the jurisdictions to start passing the mechanisms of the top-up tax. There was also a timeline proposed by the OECD where the QDMTT and IIR would be enforced as from 2024 and the UTPR as from 2025. During this process, there started a concern on how the Pillar 2 would work with legislation that was already enforced of minimum tax, mainly the United States legislation for minimum taxes. So in order to try to address it, OECD came with the side-by-side package. The side-by-side package has a few different topics there, so different kind of safe harbors. One of them is the side-by-side system, and the other one is the UTPR safe harbor, which are two mechanisms that if a multinational group qualifies for it, and mainly the UPE of the multinational group qualifies for it, the IIR and the UTPR mechanism will no longer apply for that multinational group. So, for example, United States currently is the only jurisdiction that qualify for those two systems. So a multinational group that is headquartered in the United States will not suffer the impact of the IIR and the UTPR. But remember, though I mentioned that we had three systems for the Pillar 2 for the top-up tax. So this safe harbor, this side-by-side system and the UTPR safe harbor are addressing just two of them. The third one remains untouchable. So the QDMTT is still equally applicable. In addition to that, there is also a few other safe harbors in the side-by-side package. One of them is extending for 1 more year the transitional safe harbor, which is the simplified test for the top-up tax based on the CBCR. It also introduced a permanent safe harbor, which is a sort of a simplified but not that simple calculation for the top-up tax that is not based on the CBCR, but it's based on the financial statements of the companies, and also a safe harbor for some tax incentives as well. So this is what OECD brought in the side-by-side package that is now the news that we have under the Pillar 2 concept.
Interesting. Well, Jose, indeed the side-by-side package was released thinking a lot about the U.S., if not to say by the pressure of the U.S. How do you see the package that has been released, and how do you see it impacting our tax community?
So, interesting question. I think a multi-part response to that question. I think if you start from the perspective of the United States and United States multinational groups, I think the side-by-side package was received generally very favorable. Right? They got the relief that we were seeking from the UTPR and the income inclusion rule. There had been at one point an effort to perhaps also get relief from the QDMTTs, sort of giving guilty kind of at the front of the line, QDMTT applying as a secondary tax. Ultimately, that was not achieved. But on balance, I think the package was very well received. Companies were also looking for some relief from the compliance aspect of Pillar 2, simplified compliance. Simplified is probably not the right word to use in the context of Pillar 2, but ultimately that was not part of the package. So, but still on balance, well received. There is compliance and reporting required. So that's kind of the U.S. perspective. I think outside of the United States, how it was received was probably mixed. I think some jurisdictions that had already legislated all of Pillar 2 or large portions of Pillar 2, perhaps in hindsight would have done it differently or perhaps not at all. So you can see those countries maybe taking another look at what they've done, including potentially changing their domestic legislation to also qualify for the side-by-side, carve out. And then I think the EU and the EU member states and their business community is maybe in a different position, right? Because the concept behind Pillar 2 was let's level the playing field. Everybody playing from the same kind of in principle set of rules, everyone paying 15% effective rate in any jurisdiction in which you operate. And there is a perspective by some that the side-by-side gives the United States and U.S. multinationals an unfair advantage, which was not the purpose of sort of Pillar 2 generally. But how those companies and the EU reacts is to be seen. As you know, there has to be consensus for tax legislation to be implemented across the EU either way, right? So it probably is some time before we see the ultimate reaction.
And at the end of the day, it is interesting because, as you said, I mean, it could be seen as unfair when it's so much focus in the U.S., but even the way it was published, it did leave room for other jurisdictions to apply, but not too much room, right? There are not that many jurisdictions that can apply. Brazil
is one of them.
Maybe the only one that may, and effectively Brazil did apply,
Indeed,
right?
we did apply. Brazil made the formal request for the OECD. And honestly, when we see the requirements and the structure of our legislation in terms of corporate income tax and CFC rules, my opinion is that it's very likely that Brazil will also qualify and get the same status as U.S. under the side-by-side solution.
So why?
Just if I could just make one comment. I mean, that raises the question of the durability of the system. I think people are asking that question generally anyway, even if it was only the United States identified as qualifying for the side-by-side safe harbor. Some think if more jurisdictions automatically qualify, I agree it's a self-executing carve-out. It doesn't require certification. But if more countries qualify because they make changes, does it just put enormous pressure on the system in its entirety that you start questioning whether it should remain in place or changes should be made?
Well, that leads to two interesting questions. I'll try to remember the second one shortly. But while Brazil is not accepted under the side-by-side system, I think it's interesting to hear from you, what are you seeing in practice? Was there a change in behavior in the U.S. business? Are businesses changing the way they look at their structures after the side-by-side was released?
Yes, I think before the package was released, no one had executed on any planning to change the location of high-value assets, high-value functions, but it was, I think, a work stream, right? Because, as you all know, Pillar 2 places a premium on the location of where income is earned, where taxes are paid, and you don't get credit under the system for paying more taxes or less taxes in any one particular jurisdiction. So most of the companies that were within scope were at least thinking about it, identifying options for restructuring if they had to. Now, less pressure on that. Everyone is still trying to minimize the extent that that they pay taxes, but broad changes, I think, are on the sideline.
And mainly maybe also trying to take advantage of the bill that was passed by the current government, right? The big, beautiful bill did bring a few incentives to U.S. businesses that maybe if there wasn't the side-by-side, groups were not really able to take full advantage of that package, right?
That's right. If you had to worry about the income inclusion rule and the UTPR, right, those two taxes would have clawed back the benefits under the One Big Beautiful Bill Act. So the One Big Beautiful Bill Act, OB3, I think sort of to shorten it, not related to Pillar 2, but it is, I think, Pillar 2, the side-by-side complements OB3, because there is a view that now the U.S. system is very competitive on the worldwide stage because of those provisions and the stability that came along with it. I think side-by-side just provided more stability and is causing some non-U.S. companies to consider inverting or migrating to the United States. I wouldn't say that tax drives those decisions, but it is just another favorable factor that goes into it. And you're seeing a lot of activity in that space, and some fairly large companies have already done so this year, and I think that will increase going forward. Now, it's a pretty big decision to make because, like the Brazilian system, the U.S. system is complicated, and once you're in the U.S., it's very difficult to leave. But you just have to know that going in.
Yeah, but it's still not only inversion. If we look at the market, many unicorns from all around the world will actually set up initially already from the U.S., and even if their initial operations are not in the U.S. So it is attracting investments for sure.
It is, and those decisions are mainly driven by accessing the capital markets, accessing talent, the universities, the engineers, and then why not have a good tax system to go with it?
Exactly. And going back into the other question, before I forget it, you were talking about how, right, if the side-by-side system would just be broadly adopted, that could have an impact on the Pillar 2 system by maybe making it useless, let's put it this way. So when the side-by-side package was released, I got a lot of WhatsApp messages, rest in peace, Pillar 2, and how do you see that? And the way it is now, right? So side-by-side as it is now and the way it is being implemented, how do you see the future of Pillar 2?
I think Pillar 2 is here to stay for the short to medium term. There probably are some factors that could change that, including more countries changing their domestic legislation to qualify for the side-by-side carve-out. If certain of the investment hubs or holding company jurisdictions start repealing their QDMTTs, more countries taking advantage of the refundable qualified refundable, tax credit regime, sort of things like that occurring, more pressure is placed on the system. And then I guess at that point, there are really two options. Do you just scrap the system in its entirety and you allow tax competition? I kind of see that as unlikely, but perhaps changes, margin changes, so leave the system in place, but make some fundamental changes to it is probably most likely. But, it's hard, it's a guess, but 4, 5, 6 years, I mean, there is a stock take mechanism as part of side-by-side where the OECD will come in and take a look at countries' legislation and make sure that it's at least abiding by the spirit and the principles of it. But that'll take some time. It'll take some time.
So interesting, right? So I agree. It's difficult for jurisdictions to just go giving up on Pillar 2. And of course, here there are different positions, right? There are countries that are more focused on attracting investments. Other countries do not necessarily have that mindset. Brazil has adopted the qualified domestic minimum top-up tax. I do not believe it's something that Brazil would give up anytime soon.
No, I don't think so.
And so if we look at multinationals doing business in Brazil, they need to pay attention to Pillar 2. They are subject to Pillar 2 legislation in Brazil under the QDMTT. And the Brazilian multinationals both have the QDMTT in Brazil, and until at least we are qualified for the side-by-side system, also the income inclusion and UTPR abroad. So, Priscila, how do you see Brazilian multinationals and otherwise just businesses in Brazil reacting to Pillar 2 in these past months or couple of years?
Well, I think if we look from the lenses of the Brazilian multinationals and perhaps also some of the inbound, some foreign multinationals in Brazil, I think many people were not believing that Pillar 2 would actually happen, but it did. And there was this perception that in Brazil, even if we had to adopt Pillar 2, it would not result in any meaningful change, because everybody thinks of Brazil as a high-tax jurisdiction with a 34% corporate income tax rate. So I think this first year, which was this fiscal year of 25, was a year of understanding Pillar 2 and understanding the impacts of Pillar 2 and understanding that, yes, companies can suffer a top-up tax in Brazil, although we have a 34% nominal corporate income tax rate.
Or even for banks, a much higher nominal.
Exactly. And this is because of some tax incentives that we have that are not aligned with the kind of tax incentives that OECD believes and wants to incentivize, but also due to the structure of the system. So this is not a simple ATR that companies are used to calculate based on their financial statements. There is all the nuances of the calculation. So I think this first year was more like understanding the impacts of Pillar 2, understanding where we are with it. And also understanding all the burden of the compliance and information gathering. So it was a very tough year, at least in Brazil, for most of the companies to adequate to the Pillar 2 and to the Brazilian QDMTT.
Yeah, and even, Priscila, what we saw, so our QDMTT legislation did come quite aligned with the model rules and following the administrative guidance. And it was considered not only qualified, but a safe harbor QDMTT, which turns off, right, the income inclusion rules at the level of the parents and all. But there are some relevant differences that people need to be careful with, right?
Yeah, and I think it's even more than that, because I usually say that the QDMTT is like a cake recipe, so you need to follow the recipe. But you can innovate a little bit on what to put, like on the toppings and things like that. And this is what Brazil did. So we kind of innovated on the toppings. There are some nuances on our legislation. But also the big challenge there is, when you think about the challenge of Pillar 2, it is a legislation that will be adopted by the entire world. So everyone would have the same basis of legislation. And in order to do that, to design such legislation, OECD was basing their layout of the legislation on what is more common in terms of corporate income tax rules. And Brazil is always different. Our system is different. So what does make sense and work smoothly under Pillar 2 for most jurisdictions does not with Brazil. So also there is this challenge on how to fit the legislation within our tax system, how to interpret it. And I think this is one of the biggest challenges that the companies are seeing nowadays.
Yeah, because I like the analogy that you made, but I would add, of course, you can change a little bit the recipe and add some toppings, but there are the bitter toppings, right? I mean, the administrative guidance says you can change a bit as long as you get to a higher collection of tax.
Exactly.
And that's actually the case of Brazil. The few differences that we have do end up leading to a less favorable situation than those that you would have if we're applying the model rules. And it's interesting also because then we start to see more requests for advisory work and not only compliance. Because I think when Pillar 2 came out, people really look at this as compliance, right? And
yeah, because I have the recipe. It's going to be something easy to apply, so I just need some hands to do it. But it's as Jose was saying, you can say anything about Pillar 2, but that is simple. It's not simple.
So talking about compliance, Jose, from an operational perspective, what are the challenges that you see clients facing on your day-to-day?
So I would say tax departments are a little surprised by, notwithstanding side by side, the effort that is still nonetheless required. And I think it is important to stress that side by side, when it applies, all it does is turn off income inclusion rule and under tax profits rule. It doesn't turn off the QDMTT.
Sure.
So those groups that qualify for that relief are still subject to Pillar 2. So it's still required, right? Still required is the need to understand the domestic legislation that is not always the same, right?
Yep.
Different countries draft their legislation differently, use different words. And so the interpretation, the advisory, to your point, is still required. And then you get to compliance. And I think many tax departments, right, they're yet a different set of books, a different set of data that is needed to complete the calculations and report, right, the filings to the governments. And it's important that the data, one, that you have access to it, that it's in a state that can be used, so the quality is very important. You're seeing a lot of departments having to stand up new systems to be able to gather this data, because often it's not just owned by tax. It sits in finance. It sits elsewhere in the organization, in HR. And it's just a new exercise. I think, there's a little bit of frustration from U.S. multinationals, especially because they were hoping for broad relief, but they didn't get that part of the request. And so in the next couple of years, it's a heavy lift for them to comply.
Yeah, and one thing that's also interesting, when Pillar 2 was issued, there was always that feeling that you would have time to collect all this information, especially because the returns were like long run down the road. So yeah, I do have time to do that. But it's not true. Companies didn't have that much time, especially because once you have this new legislation, you start being pushed by your auditors to tell whether or not you have a provision to book. And this pressure is, we're talking about big multinational companies, is on a quarterly basis. So companies were struggling on getting the data, and and on the need of forecasting the data, because you need to present quarterly to your auditors, to your financial statements, what is going on in regards to your Pillar 2. So compliance here is a heavy lift.
But even now, I just remember, in one of our global calls last week, some of our partners in Europe were saying that some clients are having difficulties actually filing the global information return.
Yeah.
I believe France, the system was not running very well. So, we have a deadline. The global information return requires a lot of information. It's very detailed, a lot of work on it, and it's still, in some jurisdictions, we are facing difficulties effectively filing it, and you could face penalties and all. So it is difficult. Priscila, specifically for Brazil, do you see anything different in terms of challenges and operational challenges or compliance?
I think it's basically this one. It's the same for everyone, and it's a matter of companies being able to deal with it. If we look at Brazilian multinational companies, it's very common for them to grow through M&A transactions, through acquisitions, and then you have the issue of the system. So not all your investees have the same system, so it's not always easy to get data and get data on time. So I think it's the same exercise, quite heavy for all of them.
Very good, thank you. So as we begin to wrap up, turning to some final reflections here, I think what I would ask to both of you, what recommendations would you offer to companies that are still in an early stage of adoption of Pillar 2, which many times are the local businesses here dealing with QDMTT, but I mean, some groups are sometimes late as well, and this is all new to a certain extent. So what recommendations would you guys have here? Would you like to start, Jose?
Sure, that's a hard question. I'll stick by my prediction that Pillar 2 will be around for some time. So I think you're right. Companies had some time, but not a whole lot of time to get ready. And it is here, but it is again the systems, the data, the quality of it, very, very important. I think you need to have a strategy and a plan in place to get your arms around that and be in position for the filings. I think there is still maybe an outside chance, because as you pointed out, some countries themselves are not quite ready because the complexity is on both sides, for taxpayers and for the tax administration, the taxing authorities. There's an outside chance that perhaps there's some relief from the filing deadline, but it's temporary. At the end of the day, you'll still need to have that data. You'll still have the access and be ready to comply with those requirements. That would be my recommendation.
No, I agree. Companies. I also agree that Pillar 2 will stay here for a while. So if you cannot count with the idea that you're going to get rid of it sooner. So I would recommend companies to start organizing themselves quickly as possible, because it is quite demanding to get everything you need to do a proper calculation for Pillar 2. And as Jose was saying, even if we think about Brazil, perhaps we're going to get the relief as U.S. got it for the IIR and the UTPR. But still, the multinational groups, they will have many jurisdictions subject to the QDMTT. And you need to digest the legislation of each one of the jurisdictions. You need to understand what are the nuances on each one of them. So be very careful with that.
All right, well, it sounds like this is a moment that calls for coordinated actions, preparation to mitigate risks, and to be able to ensure compliance. So yeah, interesting but tough times. And so, Jose, thank you so much for taking the time to be here with us in Brazil and talk about Pillar 2, the U.S. impact side by side. It's always great to hear your insights, and Priscila, likewise, thank you for joining us once again here. And to all of you listening, thank you for your time, and if you need anything, just always let us know. Thank you.
Thank you.
Thank you.